In this week's Property Insider video, we talk about the latest rental statistics, loan approvals, dwelling statistics, and the auction market figures. So you're going to get an understanding of what's happening in our property markets at the beginning of 2023. There are so many mixed messages. There are clues in the news which we're going to share with you. And if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Everyone seems to have an opinion about what's going to happen to our property markets this year, but I'm sure you've noticed these opinions are very mixed. However, there are clues in the news to get some insights into what's ahead, and today I want to unpack some of the recent property and economic news with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Good day, Michael, and we're back again this week, of course, but we're starting to get a lot more consolidated data to reflect on what's happening in the market. And of course, specifically, we've had the beginning of the real beginning of the weekend auction market. And that, as we've discussed ad infinitum for many years, is a very good forward indicator for what's happening generally in our housing markets. We proved that last year, of course. And we've started off with some quite heady results, but we'll speak about that at the end of the show, I think.
Well, let's start with the rental market.
Yes.
Because the rental market seems to be only getting tighter and tighter. The rental crisis continues, vacancy rates are falling, and rents are skyrocketing.
Yes, Michael. January, of course, is the major holiday month through the year. And it's a month typically where we don't see the level of demand as we have in other months in the rental market because, of course, holidays, prospective tenants are sidetracked. But and we had some results. Some of the, or most of the markets reflected that decrease in demand with steady rents and steady vacancy rates, but it wasn't across the board. We actually continued to see some growth in some of the markets, which I thought was quite interesting, Michael. We saw Sydney houses and unit rents all rise over January, up by 1.9%. Melbourne rents for houses and units also increased, Michael, over January, as did Perth, where rents for houses were higher, and in Adelaide, rents for units were higher. So I think this is another indication of how tight the rental markets are, how strong demand is, how few vacancies there are to choose from prospective tenants. And even in January, which offers some relief seasonally, we've seen rents rising in some markets and vacancy rates falling in some markets. So, it's not really good news to start the year for the rental market, Michael, but we've really been foretelling or forecasting this as to be another bad year, or tight year anyway, bad year, I guess, with higher rents for tenants.
Unfortunately, there's no end in sight because despite more dwelling approvals over the last year or two, there's not a lot of new apartment towers coming out of the ground because they're not currently financially viable. But over the last week, Andrew, there was the latest dwelling approvals, which is, again, a forward indicator of what's going to happen to our property markets.
Yes, Michael, there was some excitement from some commentators that building approvals had increased, seeming to break the recent trend, the trend of the past year of falling approvals. Of course, we had that very big surge in early 21 from the home builder policy introduced by the previous government. That, of course, has since waned as it was a short-term policy. But there was some excitement because building approvals actually increased by 7.2% over the month. And, of course, that added to the trend. So there were a lot of those that were saying that, maybe we're seeing a lift, a change in the downturn. But when we look closer at the data, Michael, and we've got to be very careful when we do look at the broad dwelling approval numbers, because, of course, they include houses and units. And units do tend to be a volatile data set because, of course, you can get a large development coming through in any particular month, which will skew the numbers upwards. And that's what we saw over December, Michael. There was a 56.6% increase in dwelling approvals, which is quite phenomenal, of course, but that reflected some very big developments coming through at the end of the year. That lifted the overall growth rate for dwellings, but houses again were lower. They were down by 2.3% over the month and remained 21.7% over the year down. Even though it was a big month for units, and that did skew the data, the underlying energy remains the same, and that in relative terms, new home building certainly is not gathering pace generally at this stage, and certainly is still providing an undersupplied housing market.
Another set of statistics that came out over the week were home loan commitments, and we pay attention to that because, again, people go to their banks, their mortgage brokers, and get a pre-approval. So it gives us an indication of what's ahead. What did you find from that data, Andrew?
Well, again, no surprise, we're continuing to see value of home loans fall, Michael. There was some talk that because when you measure home loans by value, the value is still higher than pre-COVID levels. But of course, that's because we've had a 40% increase in house prices over that period. So of course, the values are higher because you have to borrow more because house prices or home prices are higher. But certainly home lending continues to be on the downturn. In fact, this is a record decline in monthly lending, Michael, a record number of months where home lending has declined. So that sort of puts it in some perspective. But of course, confidence will return to the market this year, I believe, and we will start to see a reinvigoration of home lending. When we look at the breakdown of the data, we can see that all buyer types fell over December. Owner-occupiers and first-home buyers down by 5.3%. Investors down by 4.9%. And over the past year, or the year to December, there's been significant falls from owner-occupiers and first-home buyers, but investor numbers have certainly held up over the past year, or over the year, or over 2022, to be precise. The numbers are still higher by nearly 10% compared to the previous year. But a revival in the housing market will work its way towards increased lending, Michael.
And one of the trends I've noticed over the last little while with loan approvals is the increased trend of refinancing. People are taking the opportunity for some of those great incentives the banks are giving, cashbacks, to actually have a look at what's the best loan rate at the moment.
Well, there's been a lot of speculation, Michael, that given that there was a record number of refinances that occurred 2 or 3 years ago with those very low rates that were being, as you mentioned, offered by banks, that when those that did take up those offers 2 or 3 years ago are faced with having to refinance again, because these are typically short-term loans, that they would obviously be confronted with significantly higher rates, as high as 10% perhaps. And some have been referring to it as the cliff.
Another cliff, Andrew.
Another cliff. We've had a lot of cliffs over the journey, haven't we, Michael?
Yes.
But they just seem to disappear. But and I think this one will too as well. But look, it's a good clickbait, I suppose, and that's about all its value in terms of rationality. And I think that the latest data, which is very interesting, Michael, showed a surge in refinancing over December. And we also saw that the proportion of refinancing versus the number of owner-occupied loans moved to over 50%. So it wasn't just a higher number of loans or higher value of loans, a higher number of loans. It was also a higher market share, Michael. And I think what this is perhaps showing us is that those that did take out those fixed term loans a couple of years ago that are now faced with having to refinance are maybe doing it now, Michael, and that they're given the scare campaign that's been conducted, are taking heed of that and are refinancing earlier, which of course means that the cliff will disappear completely, because it's the very prospect of a cliff has motivated those with those fixed term loans to change over sooner than later, to take advantage of lower rates now, possibly. And I think that also that a lot of brokers are attached to their clients and are working with their clients to ensure that they can get the best deal they can. I think that was some positive news, perhaps, with that rise in refinancing, Michael, over December, and also the market share rising quite strongly as well.
I've found many brokers are proactive, and currently around 70% of all loans are being taken out through brokers. So they're protecting their clients and getting the refinancing done. Another reason I'm not concerned about that forthcoming cliff either, Andrew.
It's just another cliff, Michael, isn't it?
Well, we also know the Reserve Bank's been trying to slow out retail spending in the hope of harnessing inflation. And the latest retail figures fell more sharply than most expected. But Andrew, was this following that strong Black Friday, Cyber Monday sales boom the month before?
Yeah, absolutely, Michael, spot on. And we did have a surge over November. So there was a sense that, is this Still, we can't see an easing in consumer spending. The Reserve Bank's higher rate policy is not working. But of course, along December figures, we saw a very sharp decline. Interesting, Michael, this happened in 2021. We saw a similar energy with higher levels of retail sales over November and then a falling away over December. And of course, this is most likely due to the impact of the Black Friday sales over November, which has certainly brought forward a lot of end-of-year consumer spending. And I think we've seen that again in the data. In other words, it's new seasonal effects, with November being now a very strong retail month and taking over from December, which of course was typically the strongest month of the year. So I think, on balance, numbers are still quite high, but we need to get beyond those seasonal impacts, those new seasonal impacts, even though this data is seasonally adjusted, to see whether higher interest rates impacting consumer spending, retail spending.
We keep a careful track of auction clearance results because they're the best in-time indicator of how buyers are feeling, how sellers are feeling, and the auction markets began the year with a bang. And you report this every Sunday morning on LinkedIn, and you break it down from Melbourne, Sydney, Brisbane, Adelaide, Canberra, and also houses and units and top sales. So I'd recommend people keep in touch with you through LinkedIn, and we also publish it in Property Update. But it was a good start to the year, wasn't it, Andrew?
Well, excellent start for sellers to the year, Michael. Auction numbers were reasonable for the first weekend of the year, the first real weekend. Of course, numbers will pick up quite quickly now going forward, particularly in Melbourne, where that first Super Saturday of the year, the pre-Labor Day holiday Super Saturday, is just weekends away. So over 300 auctions in both Sydney and Melbourne. But the clearance rates were, in a sense, a surprise. Both Sydney and Melbourne recorded clearance rates over 70%. This was well ahead of the 60% clearance rates that Melbourne and Sydney recorded to end the year last year, 2022. Very high numbers in fact, record numbers really for the end of the year in Melbourne and Sydney last year, the auction market. But to be nearly 10% higher from period to period, Michael, is certainly something that's noteworthy, regardless of the lower auction numbers. And just to put it in context, Michael, this is for both Sydney and Melbourne, this was the highest clearance rate that those capitals have reported since March last year. So, and of course, we were coming off the top of the boom a year ago in our housing markets, particularly Sydney and Melbourne. So a very good start, a very encouraging start for the auction market. Of course, as you suggested, Michael, we'll need to get a few more weekends to see if these heady rates can be consolidated. But the first step has been a positive one for our housing markets this year.
I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance, and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect, and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations, and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Well, it falls in line with what agents are telling us on the ground, that there are a lot of buyers out there. I think they've put off their decisions last year, and they're currently thinking, okay, there is going to be another interest rate rise or two. Look, inflation's probably reached its peak, and they're just taking that into account and moving on with their lives, Andrew.
Yeah, that's right, Michael. And I think that, there's a growing sense that if we don't get in now, we're going to be paying more. And it's not only higher rates possibly, but higher house prices. And this is the auction results on the weekend were certainly an indication that confidence is returning to the market. And we might just start to get an inkling of that return to fear of missing out energy that drove our markets through 2021.
Well, we'll be back each week to discuss the news, the latest economic data, but more importantly, your perspective that comes with many years of interpreting it. It's fascinating how the same data is interpreted in so many different ways by people, isn't it?
Well, it is, Michael, but as I said, I think we're in for certainly a positive year this year, in my opinion, and we couldn't have started off in a better fashion, to be quite honest.
Good. Look forward to catching up with you next week, Andrew.
Thanks, Michael.